Hey, happy FinTech Thursday. No, it's not Thursday, is it?
It's not Thursday.
It's not Thursday. Oh my God. FinTech Focus on a Tuesday. I'll get the day right eventually. Hey everybody, welcome to the show. Obviously we have Aya. Aya, are you well? Where are you today?
I'm still in sunny Canada on the West Coast.
Wow. So what time is it for you now then? Like
it is 1 a.m.
1 a.m. All right, we won't keep you long. And of course,
it's all right.
And of course, we have Crypto Dave, but Crypto Dave he's kind of out and about today. Are you there, mate?
Yeah, I'm here. Apologies. Actually, now I'm kind of walking around in train stations, so I will mute and unmute, so you guys won't be bothered by the background announcements. Yeah, apologies.
Don't worry about it, mate. Appreciate you, making the time to join us. So we've got 3 topics we want to go through today. So let's kick off without further ado. Let's go with the price move. So Dave, what's happening in the market over the past couple of weeks?
Yeah, I guess I want to ask you, Paul. I mean, the price has been up and down. Recently, it's been kind of going up. It's generally from like kind of a more a general public. What are your thoughts? What are your questions? Just what's going on right now, and generally speaking.
Well, I think to be honest with you, Dave, I've learned a lot from you through these podcasts and through the live streams that we've done. That there has been fluctuation. It bottomed out about 4 or 5 weeks ago. Well, I don't know if bottomed out is the correct terminology, but it certainly dropped, and now it's starting to come back up. I was pleasantly surprised yesterday when I checked my prices. I was like, oh, that's encouraging. But it's by no means enough for me to retire by any stretch of the imagination, but there's enough there for me to go out on a good night out when my wife gets back from Taiwan, right? So that's decent. But I guess what I'd like to know, Dave, is what's driving those changes. Is there anything in particular? Is it just the market? Is Musk playing his games again? What's going on?
Yeah, so I think I mentioned this in probably 5 or 6 or 7 podcasts ago already. I'm a big believer of this kind of model of pricing something that's limited in terms of commodity called the stock to flow. I think you're probably familiar with it as well. Paul, we talked a little bit as well. Yeah. Essentially, I feel it's kind of the stock to flow market just playing out. Now, the one thing that stock and flow is not very good at is obviously pricing in kind of black swan events, like China banning, Elon Musk tweeting something ridiculous. But essentially, it's kind of playing out. So if the stock to flow model plays out by the end of this year, and I think this next 6 months will be kind of a test to see if it actually works or not. We should see a price range. This is a huge price range. A bottom, worst case scenario, $135,000, and a top line scenario, I think it's only $430,000.
Wait, say that again. So you're telling me one Bitcoin potentially at the end of this year or in 6 months' time could be worth nearly $500,000 USD?
That's based on the stock to flow market, and this analysis this analysis has been out for quite some time, and so far it has been accurate. After the first and second halving, when the Bitcoin reward basically halved, we just experienced the third one last year. So if it plays out as it is, then we have a range of $135,000 to $430,000 within the end of the year. Now, again, doesn't mean that we won't retrace from there, but that's essentially what the model is looking at right now.
Wow. Aya, is this news to you, or are you familiar with the concept that Dave's talking about?
I mean, I think the stock to flow model is kind of debated a lot on like crypto Twitter. It's kind of like there's always this kind of debate generally between like the fundamentals folks versus the TA folks and whatnot. I think, to be honest, when I look at the chart, I feel like there's sort of like it's a logarithmic scale. So to be honest, I think it's kind of like hard not to fall into that trend line just the way it's set up. But yeah, I don't know. I mean, I don't mean that in the sense like, oh yes, Bitcoin's destined to do very well. I don't mean it that way. I mean like just because of how the chart is made, I feel like it's hard to not. It's kind of like a what do you call it? A self-fulfilling prophecy of sorts. But yeah, I don't know. I'm not. I think it's what before, but I'm not much of like a trend analysis or like trader type. So I kind of look at it and go, well, that's cool.
I'm gobsmacked by that. So, Dave, only through you have I kind of been able to manage my own. I don't know what my own habits towards checking crypto. Right. So when I first invested, I was checking every hour, and then things started to improve quite dramatically, and I more or less doubled my very small investment. I was like, oh, this is nice, and then Musk said not some very nice things about Bitcoin, and then the market dropped, and then I went, right, I'm not watching it. And to be fair, that's really helped me and my mental health and my health in general, just to kind of hodl. And honestly, it was only yesterday when I looked at it, and I probably not looked at it for a couple of weeks. I went, oh, that's good. But the comment there that you've made has gone, right, I need to probably invest a little bit more now on a daily basis. I don't know if you saw this, right, but there was somebody tweeted that if you'd have bought Bitcoin, so I think it was $10 every day for 5 years, more or less when Bitcoin started, right? It would have cost you, I think it was something ridiculous like 18,000 USD, but the return on that investment would have been just short of $500,000 USD. It's amazing, right? Amazing. Anyway.
Yeah, I mean, I think at the end of the day, a model is a model based on the 11, 12 years that Bitcoin has been in existence that haven't been proven wrong. And by the way, the stock to flow market, the model, the calculation of it, it's been around for a very, very long time to calculate other kind of scarce commodities like, gold or platinum, other kind of, I guess, precious metals and things like that, where there's a limited amount of supply. So it's not a new kind of way of calculating these kind of things. You just took it and calculated using that model on something like Bitcoin, which is virtually scarce, right? Rather than physically scarce.
I have a question for you, if that's okay. So the stock to flow model, it kind of looks like, from what I can recall, it looks a little bit like a staircase, and it kind of goes up upwards, from the bottom left corner up to the upper right, and it kind of increases on a logarithmic scale. So like going from 0 to 100 is as much as 100 to 1,000, and I feel like there must be an upper bound, or like some kind of a curve towards the top, because if there's no such thing, then basically this will become explosive, and it would like fluctuate millions of dollars within a day if you followed it all the way to like the very, very tip of that chart. So what do you think of? At what point does this model exhaust itself?
I mean, to be honest with you, I don't know when it exhausts itself. It comes down to what they're predicting based on this model. By 2025, it becomes $1 million, right? That's a prediction by then. But the thing is, though, eventually there will be ups and downs, the retracements. Now, if you calculate this model, it keeps on going forever, then again, we don't know when it exhausts itself. And just like gold's been around for so long, it hasn't exhausted itself in terms of model either. Now, the funny thing is, I don't fully understand the whole staircase kind of thing. Yeah. Why is it kind of a staircase? Why not just a gradual curve upward? That's something that I'm not really quite sure when I look at charts of why Plan B, the guy who actually came up with this model, drew it that way. I don't know if he actually factored in things such as just general accumulation after a period of time, or is this way kind of a better way for people to kind of digest it? I'm not really sure.
I just think it's amazing, and I think the one thing we need to make it clear to our viewers is it's called a forecast for a reason, right? It's called a prediction for a reason. That we're not saying this is what's going to happen, but on trends that we've seen and things that we've seen in the past, there's potentially it could reach this number by the end of this year. Wow, I'm gonna have to throw some more money on it. Okay.
Yeah, but I mean, I think real quick, I think at the end of the day, everything on chain is very healthy. We got mining power kind of coming back again. On chain, transactions are healthy. Wallet adoptions increases. All the fundamentals are there. So it's not like just price is going to go up and it's going to go up just for the sake of going up because of this model, but the fundamentals are justifying why it should go up to a certain extent, right?
I remember, I think our first or second ever podcast that we did, Crypto Day, before the Wonder Fire joined the team, and you showed me a model at the start of the year, and there was, I think it was a green line and a red line, and it more or less matched, not price on price, but the kind of the flow looked the same, right? So, wow, interesting times. Okay, cool. Let's move on to the second topic, and I'll come to you next if you don't mind. We wanted to talk about the Ethereum upgrade. I think that happened on Friday night, right? So, what's happened in the Ethereum world?
So from a technical side, it's what's called a hard fork, which is
a hard fork.
Fork.
It's a family show, so it's a fork. Okay.
All right. It's a hard fork. Well, in contrast, and quite actually in reality, in contrast to a soft fork, it basically means is this change is it incompatible with the current consensus rules? Does it require people to actually update software, or can they just keep their software as is and it will just continue to play along? In this case, it's a hard fork, so it's a in a sense, a breaking change, so people do have to update their software for it to work. In this particular hard fork, I think it's 5 different changes, and these changes are represented as something called an EIP, which is a Ethereum improvement proposal, and it's similar to Bitcoin has a similar thing called the BIP, Bitcoin Improvement Proposal. Okay. And this changes are usually planned over the course of sometimes weeks, months, even years by developers. And this time, many of the changes, and they are bountiful, a lot of them revolve around how the fee market works. And also, some of it also is I would say, a stepping stone to the change of Ethereum from what we call a proof of work model towards a proof of stake model. Proof of work is the case where when you're mining, miners are guessing at, they're trying to solve a puzzle in rapid succession over and over and over again, right? And that's the work part. And if they succeed, then they mine Bitcoin. In the proof of stake world, basically, the way that's how who determine the way that it is determined who mines the Bitcoin is decided by a share of how much stake of Ethereum you have compared to the entire network. So it's a slightly different model, and part of the incentives in this case, like I said, is related to gas. So it's trying to make gas, which is sort of the fee in Ethereum, the estimate for that to be more reliable. So as a user, that means for you is you will have fewer instances of your wallet guessing your fee wildly wrong. So you overpay the fee less frequently. So it's more economical. It also does things like it will in some cases it will burn. When we say burn, it means destroy. It will burn a certain amount of the fee of transactions. So you may have heard before or from previous explanations that miners, they earn money in 2 ways, basically. One is through the Ethereum that they mine, and also from the fees. And the fees are people who are paying the fee for transactions that they make. What this new change will do is it will burn some of the fees that are being used in transactions. So miners are actually earning less. Another change also represents things like, I think they put off a change in difficulty, which was, I mentioned before just now, that some of this stuff prepares Ethereum for a transition over from proof of work to proof of stake. Mm-hmm. And for proof of stake to happen, you have to stop proof of work, right? Somehow. And so to stop it, they just make mining crazy, crazy, super difficult with proof of work. And that way, if you try to do proof of work, it's just so dang hard that you don't earn anything. It'll never happen. That's how they stop proof of work. And that was, and that's called a difficulty bomb. Difficulty is like the hardness of how hard it is to mine a certain amount of Ethereum or Bitcoin. But the difficulty bomb, it was set to go off, on a certain date in prep for transitioning to proof of stake. But they've basically, one of the changes is to put that off, to delay that into a further date. And so now the transition from proof of work to proof of stake looks like it's going to happen sometime the end of this year or early to mid 2022. How does this all affect the economics of Ethereum? I think maybe that's more Dave's area of expertise, so I'll let him take it from here.
Yeah, so how can you earn more money? Yeah, money. Hey, look, I think the biggest thing is for people to know is Ethereum used to very much operate like fiat in the sense that it could be printed to infinity. So there's no hard cap in terms of how much Ethereum could be out there. The more miners work, the more people out there trying to get some Ethereum, in terms of how Ethereum can exist, go up and up and up and up. But the idea, that Aya eloquently put it, essentially burns some of the transaction fees that would be existent. So hopefully the idea is, as more transactions happen on the Ethereum network, it will become a deflationary asset, right?
Okay.
So that's a big one. And I think another thing in terms of from an investment perspective, again, this is the whole idea of moving more towards something green. And a lot of investors are saying, hey, I can't get into certain investments unless it's kind of green. So the whole idea of proof of work is how strong your machines are to mine certain Bitcoin. This is why people say, oh, Bitcoin is so wasteful, right? You need bigger and bigger rigs, bigger electricity, more and more cooling.
Yeah.
But when you move to proof of stake, it's not about how big your machines are. It's more about how much of you own of a certain coin, right? To show how powerful you are within the network itself. So in that case, well, one, it will incentivize people to hold on to Ethereum, right? And then two, this will also become more green investment as well. So I think that's the biggest thing with Ethereum. And the deflationary aspect of it was huge. Now it's becoming the whole, on par with whole Bitcoin rhetoric saying, hey, now this is a deflationary asset, hold on to it. There's more things being built on it. The more its deflation is going to be. So yeah, it's going to be very valuable from that perspective. So actually, right before the fork, actually, I bought a couple more actually. So yeah, we'll see where it goes.
Question to Aya and to yourself, Dave. So what I heard from that, from a layman's perspective, is it's going to be harder to. My takeaway was it appears like it might be harder for miners to mine Ethereum. So does that mean that there's going to be less Ethereum in, what's the word, circulation, because it's going to be harder, or is it just going to be they're going to have to work a little bit more to get more? How is it going to work from a mining perspective?
I think in a short term, yes, miners will be earning less from things like fees, transaction fees. I think they're hoping to use when I say they, who is they? They are the developers and, I don't know, people who are the larger community of Ethereum see this as again, like I said, that stepping stone towards a proof of stake, which if that happens, rather than earning Ethereum through owning specialized machines that are very good at doing those puzzles, is now replaced by you are a high earning miner if you own more Ethereum. So the sort of the game mechanism has changed. And so sure, it's in the short term going to be harder and they will earn less fees. But I think there is a little bit of a dependency or an expectation that Ethereum's value will increase over time, and they're helping to ensure that by making it, I wouldn't say it's quite deflationary yet, but it's not as inflationary as it was. So we're not in the deflationary stage at the moment. We're just inflating much more slowly than we were before.
Perfect.
And so that's the other assumption. And again, if they were holding on to their Ethereum instead of selling it at every opportunity that they had, that huge stockpile of owned Ethereum that these miners have are the key to mining and earning more Ethereum in the future. So I think a natural follow-up question to that is like, oh, what is, doesn't that mean that the rich get richer? It's kind of like this whole philosophical thing, and actually there's a whole bunch of things that disprove or are in that contest against that. But I think that's maybe for a different episode. I'll get to that one in another time.
That sounds like that's an episode that will require maybe 1 or 2 drinks for us to get through. Right?
Yeah, a few more.
Perfect. Okay, so let's move on to the last topic. I know, Dave, you're currently out in the wilderness, so we'll try and keep this one a little bit shorter than normal. So, Crypto Dave, your last topic that you want to discuss was the infrastructure changes that's happening in the US, right? So just explain as easy as you can for the man in the street what's happening in the US, Crypto Dave, and what are the challenges that we may see?
Yeah, so there's a big infrastructure bill being pushed by the Biden administration. I think it's $1.3 trillion. And a lot of presidents do this. When they come into office, they want to push a big economic reform bill that increases employment, right? In this case, would be infrastructure, roads, healthcare, yada yada yada. And as part of it, they want to push quote unquote bipartisan, policies, amendments to whatever the bill is. Obviously, it's $1.3 trillion. There's a lot to it. But one thing that they want to put in there to maximize the ability to actually fund this $1.3 trillion bill is taxation on cryptocurrency, as well as taxation, responsibilities on people who are responsible for handling cryptocurrency in any form. And the language is in a part very, very vague. So basically, as you can think, anybody who is a money transfer, so buy and sell a cryptocurrency or be able to hold or custody cryptocurrency fall under this remit in terms of taxation liabilities to the IRS, right? But now they have made it very, very broad. So anybody basically who are handling money on behalf of someone will be under this taxation rule. So what does this mean? So if you are handling, quote unquote, some kind of digital transaction on behalf of someone, you need to do things such as report the person's name, how much the transaction cost is worth, who is it being sent to, blah, 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 blah. But it's worded in a way, people like miners who are actually mining and securing that network. So for example, I want to put an NFT onto the Ethereum network. I'm an Ethereum miner, right? So I am going to use my computing power to secure this transaction, saying that, hey, this is a verifiable transaction. Me, myself, as a miner, now are liable to taxation reporting to the IRS. But that's not possible, right? People who are securing network don't know this kind of information. It's all out there in the system. It's being run by, pseudo-anonymous, networks at times. It's something impossible. So this is something that's very, very hotly debated. And actually, it's one of the reasons why this $1.3 trillion stimulus bill is actually being delayed at this moment, is some of the senators actually pushing back against this wording.
Interesting times. How is it going to impact the average man in the street if it comes into legislation, or will it just require what you were saying there, more form filling for people that are doing transaction on other people's behalf?
Well, the thing is, it's impossible, right? You cannot, as a person who's securing the network, you don't know who is the party sometimes, right? You can't do things such as name collecting. You don't know. You just don't know who is on the other side a lot of times. So if that's the case, it's not possible, and it's not realistic to ask this kind of information. And then for a money transaction, you need to report in a lot of details anytime the transaction is worth over $10,000 in terms of value. So it's just not possible. And I think two things will happen. If this passes, one, a huge drain of the cryptocurrency related industry out of the US, and or two, will go complete underground, and where it becomes very difficult to actually regulate. It's kind of like prohibition. It's worked, but it didn't work really badly because essentially they made it so restrictive that it became unregulatable anymore.
Interesting times. Any thoughts?
Oh, many thoughts. First of all, I think that this bill has potential to affect way more than just miners, right? This, I mean, as Dave said, this will or could apply to anyone who simply even transfers or partakes in the Bitcoin network at its most, I would say, at its loosest definition. So there's definitely a lot of incentive for people to care about this piece of, I guess the word is legislation.
I guess.
I think there's a bit of optimism in what Dave said, and he said like, "Oh, it's impossible for them to regulate this." And sure, I think that on the technical standpoint, that is true. I think that the vagueness and the very broad language used in this bill is absolutely by design. It's not out of like ignorance or misunderstanding of how Bitcoin or crypto works. It's entirely purposeful and is just designed to be like this. You know what? How would they enforce stuff like this? Well, it could come into the form of penalizing or banning mining activities where the payouts to, let's say, mining pool members is prohibited in cases where all the members haven't been KYC'd, which means like had their identities checked and background check done. It could take the form of further regulation on how exchanges process things like withdrawals and deposits. And if you're familiar with regulation, you may have heard of this thing called like the travel rule, which is sort of an upcoming piece of it's a guidance from the Financial Services Agency, the FSA, which basically sort of outlines if you are engaging in cryptocurrency-related business, these are the things that you must do from a regulation standpoint for the safety of the general public in terms of preventing fraud, money laundering, and preventing the funding of terrorism. So I think the four horsemen of scary money crimes will be invoked at any opportunity to make a bunch of regulations and stuff. And please don't take this like I'm totally against it. I think that there is a place for some of this, but I think the way that the U.S. bill currently looks is a little bit of an overreach, and I hope that they continue to tweak it. Tweak it in my favor. Tweak it in my favor. Yes.
Do you think this is an attempt by the governments to gain control back in the US we're talking about at the moment, right? So is this an attempt for them to get back a little bit more control over what's happening in the crypto space? Do they feel that they're not involved in it as much as they should be now? Or because I think one of the best things about crypto is it's to coin a phrase, it's for the people by the people, right? Or by the people for the people, whichever way you want to phrase it. Do you think this is an attempt for government to kind of pull some control back?
I think yes, obviously, but whether that's in the best interest of you or not, I think it depends on. I guess it depends on your political belief. And I think, like I said, there's a place for this, and if you think that nothing is black and white, so there are definitely sacrifices that we make to make things safe, to make things comfortable for people, and I think everyone has a slightly different line of where that is. But personally, in this case, I'm not too happy with what the bill looks like, so I'd like to see some changes.
Yeah, I think you're right. You're right. I think it needs to be a little bit more ironed out, a little bit more specific. Right. Cool. Okay. So, Crypto Dave, let's come to you for the last comments of today's episode, mate, before we lose you. Anything else you want to talk about?
No, that's pretty much it. And just I guess our last comment, just in generally speaking, is it is a kind of an aftermath or a kind of byproduct of everything that's going on with the infrastructure bill. This thing is hotly debated in like center stage. So it's actually a really good marketing for Bitcoin and cryptocurrency in general, because now the general public can see, hey, this is a hotly debated bill. Maybe we should take a look at this. So I think that also, to a certain extent, has some effect in terms of the current price rise. Yeah. So exciting times.
Excellent. Anything that encourages conversations about a topic is always a good thing to start. Right. So, cool. All right. Anything else before we go?
No, just there's no such thing as bad press. So
no such thing as bad press. No. Speak to Hugh Grant. Speak to Hugh Grant. There is no such thing as bad press. Cool. And Crypto Dave, thank you so much for joining. Audience members, thank you for your comments. Please let us know what you'd like us to discuss. We're here every Tuesday at 4 p.m. local time. Everybody else, take care. Have a great week. Crypto Dave, be safe, mate, wherever you are. Take care, everybody.
All right.
Bye.
Thank you.
bye.
Bye. Bye.